Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Malcolm Ferguson of Octopus Ventures to talk about the Octopus Titan VCT. Hello, Malcolm. Welcome to the studio. Firstly, could you start by giving us some background to Octopus Ventures and your own experience?
Of course. So Octopus Ventures, we've been around since 2007. We're best known for managing the Octopus Titan VCT, which is now the biggest VCT in the market. It's 1.2 billion in net asset value overall. I'm a partner in the team. I joined back in 2013, so I'm in my 9th year. Day-to-day I sit in fintech team, so I make fintech new investments and I sit on the board of about 9 of our portfolio companies. And this year I took over as lead fund manager of the fund.
And so can you tell us about Octopus Titan VCT?
Of course, so Octopus Titan VCT, as I said, it's the biggest VCT in the market. It focuses on investing into UK-based technology and technology-enabled companies. So what we deliver through our investors is we give them generalist exposure via specialist expertise. And we have these 5 specialist areas, which we call pods. So deep tech, fintech, health, consumer, and B2B software. So our team's essentially scouring the UK for the very, very best entrepreneurs in their space every year. And we aim to deliver that to investors. What does that mean? It means we deliver capital appreciation and dividends. We pay an annual dividend to our investors.
So what types of companies are you looking to invest in?
So UK-based technology and technology-enabled companies at the seed and Series A stage. So they're right at the very, very beginning of their lifetime. These are businesses in those 5 sectors that I mentioned: fintech, deep tech, health, consumer, and B2B software. Probably the most important thing we're looking for is the quality of the founder. The founder is paramount above all else, even more important than a great idea. And so we're looking to find these amazing founders who have incredible vision, and we look to back them, hopefully, for the next 10 years plus.
And is there anything you avoid?
Within founders? So there's plenty of things we avoid, yes. We see probably 3,000 plus business plans every year. We'll spend a lot of time with 10% of that number, and we'll only invest in about 30. So we're really filtering down. What we're looking for is really talented, really ambitious founding teams who can attract talent, can raise capital, can attract customers. It's a really, really hard job. They're able to demonstrate incredible growth, or at least growth potential if they're really early in their journey, and usually very technology driven as well.
So have they normally done it before then?
Well, there's 3 types of founders we back. The very best, the one everyone wants to back, are the serial founders.
Yeah.
People have done it before, they've been successful, they've got a group of people they really trust, and they bring them for their next businesses. They're relatively low risk founding teams because the execution risk, which is often the biggest risk, is reduced. That you can't always back serial founders, there's not that many of them. So we also back people who have worked for these amazing founders. They've learned what greatness looks like. They've learned how to attract talent, how to tell a story, how to execute as a company scales. These are really hard lessons. They learned them under someone else. There's also a group of people who have a view or an idea that they've developed within another industry. So it could be they've worked in a large incumbent. There's this problem that really annoys them. They just can't fix it within the incumbent. So they start a business to try and dedicate their next 10 years to try and fixing that problem.
So Malcolm, can you give us some recent examples of companies you've backed in the VCT?
Yeah, well, we invest in the last 12 months, 35 new companies. So we invest in a lot of new companies every year. We're seeing 3,000 to see those 35. To give you a couple of examples, so a company, Minimum. So Minimum helps large, complex organizations reduce their carbon footprint. So a really important problem, one we hear about a lot. How do you do that? First, they have to track and measure how much carbon a company emits. They do that by plugging into their software system. So, for example, their accounting software. They look at all the transactions and they can see exactly how much carbon that company creates. Off the back of that, they help you benchmark and reduce your carbon footprint. They then help create automatic sustainability reports. And the best part of all is they connect the loop and they connect you with offset projects so you can actually reduce your footprint. We led the seed round last year. They've just raised although not yet announced, they've raised the Series A in October. Another one is actually from our fintech pod called Tatum, which is a business that helps people develop blockchain applications cheaper, quicker, and easier. And this is really fascinating because blockchain has been a topic and a buzzword for the last 2 or 3 years. We could try and say, this technology is going to be incredible, or this app will be incredible. We wanted to find a way of getting exposure to all of these opportunities. So this is an enabling technology that helps people build apps in days, not months. We led their seed round last year. In October, they just announced a 40 million Series A. So they've really shown some incredible traction, and now they're well funded to continue the next couple of years.
So how are you finding these investments? How do you source these?
Well, we're lucky enough to have a team of 35 people, which is one of the largest investment teams focusing on technology in Europe now. And we split those teams into these sectors. So as I mentioned before, fintech, health, deep tech, consumer, and B2B software. So for example, in the fintech team, all they do, eat, sleep, and breathe fintech. They're looking at themes, they're writing research, they're going on panels, they're trying to build their presence in the ecosystem so that founders can come and find them. That's one great source. We try and see where people have left a really successful company and are starting their own business. We'll go and find them and talk to them and hear what they're building. And a lot of stuff comes from referrals. So we spend a lot of time building our network of earlier stage funds, angels, and they will introduce opportunities to us. So there's a lot of different ways. We see, as I say, thousands of businesses a year. And so we want to see everything, but we really want to be very selective. Less than 1% of the opportunities we see will actually do.
So Malcolm, moving back to the portfolio, are there any examples of some of the more established names in the portfolio that you can talk about?
We're very lucky that we've been investing for 14 years now. So our portfolio has grown to over 115 companies. The joy of venture capital is you make a cohort of investments and then a small proportion of those start to break out and drive performance. To tell you a bit more about some of those, so there's a business called Skin & Me, which is a direct-to-consumer business for skincare. So it helps people treat acne or aging or other certain skin conditions. The thing that's really interesting about this business is if you have a skin problem, often people will go to a pharmacy and they'll get something that doesn't really work for them. Or they could go to a dermatologist, wait on a 12-month waiting list, and hopefully go and see someone privately. So those are your options. Neither are that good. What Skin & Me have done is they've got a team of prescribers, physicians, and dermatologists on their payroll. They will create a perfectly bespoke skin cream for the individual, and they will deliver it to your door. Every month that mixture changes as your skin changes. And they've been around now, we invested in 2019. They have over 5,000 Trustpilot reviews, 80% of them are 5-star, so people adore it. Another example is a company called Big Health. So Big Health is from our health team, as the name suggests. They are a digital therapeutics company that treats insomnia and anxiety. One of the things I was shocked by when I heard about Big Health and what they were trying to build was 1 in 3 UK adults suffer from insomnia. If you go to a GP to try and fix that, what they are recommended to do by NICE guidelines is to give you a therapist who give you what's called cognitive behavioural therapy. But because there's not enough therapists, they give you sleeping pills, which have side effects and they don't work very well. What Big Health have done is they've taken cognitive behavioural therapy and they've made it available in software. So they can remove the therapist bottleneck and they can deliver it to you through an app that you can use whenever is convenient for you. It's clinically proven. They've done over 60 clinical trials to prove it's more effective than sleeping pills, and it can be delivered like unlimited way to anyone that needs it. The NHS in Scotland actually prescribe it. GPs in Scotland can give you this product.
And ManyPets, largest holding in the portfolio, how's that performing?
So ManyPets is one I'm very proud of. It's one of the ones I sit on the board of. We first invested in 2016. The business has gone from strength to strength. They're now a top 5 insurer in the UK. They launched in the US last year. They announced a very large funding round in May 2021, which was very good timing. It was a good market to be raising money. They raised over £150 million, which they're now using to now try and dominate the UK and the US pet insurance market.
Interesting. So besides funding, what do you do to help these companies succeed?
The funding is the easy bit. The next bit is the 10 years of sweat and tears that go into building a startup. The first thing we do is we typically take a board seat on every company that we invest into. That means we can be the person that the founder comes to and help them through the ups and the downs of that journey. As we've got bigger, we've invested into more kind of focused and specific areas that we think all founders need help on. So first one is, our belief is that the quality of the team and the probability of success is driven by the people that founder surrounds himself with, the talent. We now have a people and talent team of now 6 people, hired out of all the big successful scale-up companies. So some of them have hired thousands of people in their careers, and they work for us to help our portfolios be more successful. And they're generally hired within the verticals. So we have someone from Checkout.com, which is a $40 billion fintech company. It sits within the fintech vertical. So someone from DeepMind, it sits within the deep tech vertical. So their job is to, one, help from things like, which HR information system should I use? Can I get a coach for the CEO? What's comp benchmarking? I need to find an amazing chief revenue officer. Who should I use to find that person? They help with that question. And the other one is, in venture, it's a journey of steps. So you raise your seed round. If you do well enough, you raise your A round. If you do well enough, you raise your B round. Eventually, you raise enough money, like many pets have done, that they can go really big and become a multi-billion-pound business. That's the journey. But you need to raise money at each of those steps. We're really well positioned to help them with that. So we call it our raise function, and we help our companies raise their next round, help them with their plans, introduction to investors, all sorts of different things there.
I guess in turn, that's quite a powerful pitch to entrepreneurs seeking funding. I guess you're using that to try and win some of these deals.
Win rate of deals is the most important thing. There are 3 core KPIs in venture capital: see, pick, win. Do you see the right opportunities? If you see them, can you assess them? Third, can you win them? The very best founders choose their fund. We often have 3 or 4 other funds competing for the same opportunities that we're looking to win. So when we come to the table, we have to be much more than money. These functions I talked about, those are critical. They are often the reasons people choose to work with us. Our sector specialism is another one. We have a lot of existing portfolio companies that have similar customers, similar problems, and they can share learnings, and that's been really powerful for us.
So changing topic slightly, the current environment's become a little bit more volatile. Is that affecting the way you invest?
Very much so. Maybe sounds strange, but venture capitalists love the opportunities that recessions create. And I'll explain why that's the case. So there are a couple of things that happen in a recessionary environment which is beneficial for early stage. We may even be entering the best time in a decade to build a new business and therefore invest in them. Why? So talent. Talent is one of the most important inputs. It's been the most difficult thing to achieve for these founders over the last few years. All the big tech companies are hiring thousands of people a year, offering them every benefit you could have and really high salaries, a lot of big growth rounds, a lot of people hiring. It was called the war for talent because it was impossible to get great talent. Year to date in 2022, there's been over 100,000 redundancies. Terrible. Hiring freezes, big tech are letting people go. This is not great, clearly, for the economy, but the silver lining is there's now available talent for our companies to hire. So this is actually a really nice silver lining. The next one is funding scarcity. So because there's less capital available at the growth stage, we've not talked about that, but maybe we can come to it a bit. There are less companies getting funded for the same idea. Competition is one of the best ways of eroding profit. So if you have less competition, you have a better chance of being successful. And the third reason is incumbents retrench in periods like this. They stop investing in innovation and they start to protect their EBITDA. That creates these windows of opportunity that our founders can tackle.
So how's the environment affecting the companies that you're backing? How are they performing?
So this is the area that we're most focused on because we have a big portfolio. We need to make sure they're well funded and they're navigating the environment. The main headwind that's experienced with this current environment is that there is a reduction in the amount of growth capital available. So the follow-on funding risk has increased for our portfolio. The way they're navigating that is they are taking steps to reduce burn, slow hiring, and sacrifice growth, but to extend their runway. When we looked at our own portfolio, we asked them, how much runway do you have? And we tracked the overall portfolio net asset value, and we saw, really pleased to see, 85% of our NAV has over 12 months of runway. In fact, 70% has over 18 months of runway. So they're very well funded.
When you say runway, you mean the amount of cash you have left to fulfill your business plan?
Before you need to raise money again, or can get to profitability. Yeah, thanks for clarifying.
So have you felt the need to revalue your portfolio at all, given the falls in the stock market?
We have indeed. So we value, as a VCT, at least twice a year, and we value every company bottom up in June and December. So we valued most recently in June, which was published with our accounts in September. At that point, about 60% of our portfolio was valued on an external price. So it's a price that other investors have paid, or an exit offer, or a term sheet for a new round of funding. So this external valuation point is for about 60%. The remaining 40% is valued on multiples. So these are very much judgment-based. We have to rely on things like public market comparables, which have fallen drastically for about 40%. And that 40% also we work alongside an auditor to make sure, and a lot of internal process to make sure that judgment is sound. We're looking to be fair value, it's called. So the NAV year to date has fallen as a result of us reflecting a lot of the multiple compression we've seen in the market. And also, in fact, some of the headwinds around fundraising that companies will have in the 2022.
I guess when you're issuing new shares to investors, you have to make sure that the NAV you're issuing those shares against is the fair value.
Correct. And we check this all the time. Every time we have a share transaction, which may be a share buyback or a dividend reinvestment or a share allotment, then we will look at the NAV again.
And so what are the biggest challenges you currently face?
So the biggest challenge at the moment is the access to growth financing. And so we are spending a lot of time with our founders to make sure they're taking prudent steps and understanding actually there's been a really drastic shift in the mindset of investors in the venture capital ecosystem more broadly. Last year was very much what has been labelled as growth at all costs, where growth was valued, profitability was not, and therefore people were rewarded for taking significant cost but to get maximum revenue because you will exit on a very revenue multiple, so that was a good decision. What's changed now is because the cost of capital has gone up, people are much more focused on how efficient you are with that use of capital. So founders are needing to change their strategy to be more efficient and to not just focus at growth at all costs, but to focus at profitable growth. Something we've been around since 2008. We saw what 8 to 10 window was like. It was very similar to now, where the capital was not available. So we've experienced what that feels like, and therefore able to share those learnings with the teams.
So how risky is this? So say for every 10 companies you back, how many do you expect to fail?
So making a new investment in a young company is very risky. Of every 10, we would expect maybe 2 to really matter, to be return drivers, maybe 3 or 4 of those to be, get your money back maybe, and then half to fail. That's what you'd expect in a cohort of new companies, which is why in venture capital you want to be diversified and invest in many more than that. If you invest in something like Titan, we're not just investing in 10 companies, we've already invested in 180 companies since 2008. In fact, half of the net asset value sits in companies which are quite mature, have potentially raised tens and tens of millions, potentially have hundreds of millions in revenues. So the underlying net asset value is actually quite mature. But we also have this cohort of new 30 companies every year which are new and risky. And the way our strategy is, we like to invest in 30 companies a year, but we like to follow on into only a proportion of those which have proven their own strategy, proven out the hypothesis, are performing well. So when we look at failure rate, probably about 20% of all of our investments we've ever made have failed, have lost money. But that's on a per investment basis. If you look at per capital, it's only 16% because we invest more into the better performing companies.
So what about exits within the portfolio? Any recent exits you can talk about? See, last year was a good year.
Last year was a great year, yeah. If I look from January last year to now, we've had about almost 300 million of exit proceeds. To put that in context, that's the same as the net asset value of the second largest VCT. So we did an incredible number of exits. I'll talk about a couple last year and a couple that have happened this year. So last year, the 2 most notable ones for us were a company called Depop, which is a global fashion community. We sold it to Etsy for 1.6 billion. So it was our second fully realized unicorn company, first one being Zoopla a few years before. And then the next one was a company called Wave Optics, which makes the lenses that go into smart glasses. And we sold it to Snap for a rumored valuation of more than 500 million. Those two were 2 really, really notable exits. And it's the example of what we're trying to build, these outlier companies. 2022, the exit environment is more challenging. Valuations have come down. So it's more difficult to realize companies. However, we have a cohort of really great companies. So we've actually sold 3 companies to date, full profitable realizations and 1 partial. Overall, we've generated about 50 million in exit proceeds just this year in the first half of the year. One of those companies which we sold this year was called Glowfox, which was a gym management software. Essentially helps gyms not have to worry about their IT system. They just want a website that they can book people, they can arrange classes, all this stuff that you'd expect. You book via your mobile app. They don't want to have to deal with that. Glowfox deals with it, and they sold it to a big gym software chain in the US this year.
So what about the performance of the VCT as a whole? How's it been performing?
So when we look at it on a year-to-date basis, it's actually declined at about 11%. That's driven by a couple of factors that I mentioned. So companies having to raise in this period are having to do so at more aggressive terms than they otherwise would have. Multiples have come down. About 40% of of our portfolio is valued on a multiple basis, so that's all been reflected. Kazoo was a big holding. It's one of our top 5 holdings that's fallen quite materially, over 90% in the public markets, in spite of incredible underlying performance. In fact, they generated over $1 billion in revenue run rate currently. So performance of the company very good, but the share price not so good, as has happened for a lot of public tech companies. When we look at it last year the NAV was up 20%. So last year was a very strong year. This year to date has been more challenging. When we look at venture capital performance, it's better to look at it on a longer term period. So when we look over a 5-year period, which is the holding period for a VCT shareholder to maintain their reliefs, we're at a total return of 28%.
And what about dividends? What are you targeting, and are you confident you can continue to achieve that?
Yeah, dividends, we target 5p per annum regular dividend. In the dividend yield, that about 5% as well. So 5p is roughly 5%. If NAV grows very quickly and we get a lot of big exits, like happened last year, we'll also pay a special dividend. Last year we paid a 6p special. It's unlikely we'll pay a special this year because NAV has fallen, but dividends is 5p per annum is what we target. We set this target a number of years ago and we've hit it every year. One of the beauties of having such a big VCT is we are able to do these things in quite a predictable way.
So to sum up there, Malcolm, for those that want to invest in a VCT this year, why should they invest in the Octopus Titan VCT?
Okay, so in summary, Titan is the largest VCT in the UK. It offers investors generous exposure to the venture capital asset class, which is important because you want to be exposed across vertical, but it's delivered by specialist expertise, and specialists tend to outperform generalists because they can see, pick and win the very best companies in their particular space, and their peers will do the same in other verticals. Titan is a big, established and diverse VCT, 1.2 billion in asset value, 115 portfolio companies. We're making 30 new investments per year. As an investor, new investor to Titan, you get exposure to the full 115 companies, including the winners that have emerged already that have not yet been sold. You also get the diversification across time, so 14 years of investments. The oldest company is actually in the portfolio for over 12 years. Sector and maturity. And finally, in terms of returns, last 5 years, total return 28%. We pay a dividend every year of 5p as our target, and we've been able to achieve that ever since we've set that target.
Malcolm Ferguson of Octopus Ventures, thank you very much.
Thank you.
If you are watching on YouTube, please press like and subscribe to the channel for more.